Greetings. My name is Ted Hicks. I am the founder, CEO, and Chief Investment Officer for Hicks Associates Wealth Management. Today is Monday, November 1st, 2021, and this is our monthly market monologue to review the market's performance for the month of October, talk a little bit about some of the things that we are concerned about. Before we dive in, we got to make sure that we put up the disclaimer to remind everybody that there's no specific advice. You shouldn't be taking any specific advice from this video. This is just for informational purposes only. If you have any specific questions, we would encourage you to reach out to your financial advisor or your tax accountant, or perhaps both. Naturally, if you do not have a financial advisor, feel free to reach out to us. My team and I would be more than happy to see if we can be of service to you. My contact information is on the screen. So that said, let's dive in. We're going to start by looking at the performance of the market as measured by the S&P 500. As a reminder, the S&P 500, we like to say there's 500 stocks in there, but there's technically 505. Overall, it had a good month for the month of October. It was up approximately 6.5%. We switch the view and look at it on a weekly basis. I'm simply trying to highlight the fact that there was 4 solid weeks in a row for the S&P 500. So that's good to see. When we see the data on a daily chart, we see a couple of days where the market jumped and it gapped up. I always like to see that, especially when it's a gap up. Don't like gap downs very much. So switching the view to the chart for the Nasdaq. Again, the Nasdaq is a little tech heavy, but it also has about 4 times as many stocks as the S&P 500. So when you're comparing, you might argue that the Nasdaq is a worse measurement for us to look at because it's tech heavy, but you might argue that it's a better measurement for us to look at because it has 4 times the number of stocks. So instead of using one or the other, we like to look at both. And when you look at the Nasdaq performance for the month of October, again, you see a nice tall white candle. That is a very positive month. Again, 4 solid weeks in a row, bouncing off of the 20-week moving average. That's the green line. So again, on a daily chart, we see a couple strong days where the market, the Nasdaq just gaps up. And again, it ended up, by this measurement, up about 8.7% top to bottom, but we'll come back and we'll look at the actual performance because that was top to bottom. That wasn't start to finish, which is 2 different measurements. Now let's look at the Russell 2000. Russell 2000 is a measurement that we like to look at that measures the performance of smaller companies. So the Nasdaq and the S&P 500 tend to be big companies. The Russell 2000 is the small companies. By some measurements, the small company stocks are going to be a good indicator of the overall health of the economy. It's small companies that make up about, I think it's about 70% of the jobs that are out there. So how small companies are doing is pretty important. And what we see, whether you're looking at that monthly chart or you're looking at this daily chart, the small cap sector has really just moved sideways all year long. On the left-hand side, I've got this black line indicating the first trading day of the year, January 4th. You see I've marked March 15th as the high for the year, and then this other black line is October 1st. Okay, so what we're trying to show here is the sideways movement. We would call that a basing pattern, and at the end of the month, the Russell 2000 was about 2.8% away from that March 15th high. Now, again, today's Monday, November 1st, and as I'm recording this, the small company indexes are having a very good day. Earlier in the day, I don't know where they stand right now, but they were actually up like 2.5%. So it is very possible that in the next day or two, we could take out that March 15th high. Taking it out is one thing, but do we move beyond that? Are we really going to break out above that March 15th high? If we do, that would be a very good sign for the overall economy. So overall, the month of October was a good month. That CompX red line, that is the Nasdaq. So start to finish, not top to bottom, but start to finish, the Nasdaq was up approximately 6.8%. The S&P 500 is the green line, that was up about 5.6%. The Dow Jones Wilshire 5000 is the DWC. That is a much broader measure of the overall health of the stock market, but most people don't follow it, so we don't talk a lot about it. The blue line is the Dow Jones Industrial Average. I don't like to talk a lot about it because there's only 30 stocks in that average. The only reason we will mention it every once in a while is because the news media mentions it. And the reality is the news media reports the Dow Jones Industrial Average because they always have reported the Dow Jones Industrial Average because it's one of the first indexes that was kind of created as a measurement of the overall market. Then that last maroon line is the Russell 2000. That is the small caps that we were just looking at. But before we go on, we should also highlight the fact that just because we had a good month in October, that doesn't necessarily mean that we erased the losses that we might have experienced in the month of September. Sometimes it is said that the stock market on the way up is like an escalator, but on the way down, it is like an elevator. So sometimes when the market moves south, when the market moves down, it moves down a lot quicker than it moves up. So we had a bad month in September. We had a great month in October. That doesn't mean the October month is going to erase the September month. But what's important is the trend. And so that's what we're going to talk about now. We're going to start looking at what we call, or what the industry calls, breadth. Breadth is a measurement of the overall, not just the overall index, but what's underneath the surface. Remember, the S&P 500 is a market cap, it is a cap-weighted index. So what that means is the bigger the stock, like the Apples, the Netflix, the Amazons, those are trillion-dollar companies, they are overweighted in the S&P 500. Same thing is true in the Nasdaq. And so what we want to look at is how many stocks underneath the surface are actually performing well. And so in the month of September, you can see the red line that I've drawn on that advanced decline line, which matches the trend in the overall S&P 500. Again, on the green line at the bottom is the S&P 500. The black line at the top is that advanced decline line. As a reminder, the advanced decline line is a cumulative total of the number of stocks that are advancing minus the number of stocks that are declining. So in I believe it was the first monthly market monologue video that I put together, I was showing that the advanced decline line actually has a negative slope to it, even though the S&P 500 in this time period had a positive slope, and that was a very big warning sign. And then in September, we got the confirmation. The S&P 500 did turn down, and you saw this, the advanced decline line had the same trend. Well, now we have the inverse. The S&P 500 advanced in the month of October, but the good news is so did the advanced decline line. So now we have more stocks in the New York Stock Exchange that are advancing than are declining. So that is a good sign that the market is getting healthier. So another way that we're going to look at that is the number of stocks that are above their 200-day average. And again, we're going to look at the S&P 500. The 200-day moving average is approximately 9 months of stock market trading days. So that is generally considered to be a long-term trend. So if a stock is trading above the 200-day line, it's considered to be in an uptrend. If a stock is trading below the 200-day line, it's considered to be in a downtrend. And you can see that I've drawn on here October 1st. I also drew April 21st, which appears to be about the high of this measurement earlier this year. But ever since April 21st, more and more stocks were starting to go below their 200-day line, which is a cause for concern, which is what we've been talking about. So the way that we would use this measurement now is to say, well, has the trend changed? Are there more stocks that are starting to improve, like we did on the last chart? And we do see that. So the month of October started here, and we are starting to get more stocks rising back above that measurement. Right now, the month ended at about 70%. So 70% of the S&P 500 is trading above its 200-day line. So 70% of the S&P 500 is considered to be in an uptrend. That is a good sign. This is the Nasdaq. So the black line on the left is January 25th. Ever since January 25th, the number of stocks on the Nasdaq, again, there's 4 times as many stocks in the Nasdaq. So ever since that day in January, more and more stocks are going below their 200-day line. That is not a good sign. But again, is the trend changing? Well, right now we have about 34% of the Nasdaq above its 200-day line. And that is a slight improvement over the beginning of the month. So we would say the trend is beginning to change. We'd like to see a little bit stronger movement there. So we'll see what happens in the month of November. Now we want to look at something that is referred to as the relative rotation graph. The relative rotation graph, in this particular case, I've got the 11 sectors of the S&P 500 on the screen as one of the lines. I also have a commodities index in there just to give us a reference point. And what we're comparing with these individual components of the S&P 500, I'm comparing the individual component to the broad S&P 500. The broad S&P 500 is that middle dot right where all four quadrants come together. And I'd like to explain this in relation to like a horse race. It's kind of easy for us to understand. That top green quadrant, that leading quadrant is going to be the horses that are at the front of a horse race, okay? The blue quadrant, the improving quadrant, is those horses that are beginning to make a move and they're beginning to challenge those horses that are at the front of the race. The yellow quadrant in the bottom right, that's our weakening quadrant. And so that the example there with a horse race would be, maybe it's a horse that jumped out of the gate and it got off to an early lead, but it's already weakening. It's already falling back on the pack. And then the pink quadrant is the lagging sector. So what I'm trying to show here, you can use XLRE in the blue line in the bottom right. That is real estate. That's the real estate sector. And XLE in the top left. Use those two to get an idea of what's happening. So you see real estate is weakening and energy is strengthening. But we would also look at the length of the tail. So the length of the XLRE tail is much shorter than the length of the XLE tail. And so what that's saying is, yes, there's negative movement or negative momentum relative in real estate, but the positive momentum in energy is far greater than the negative momentum in real estate. So you might have witnessed some pressure in the real estate market. Maybe you haven't seen that just yet, but it does show up here. And then again, the energy sector is making a very strong move. So that's good news if you are invested in energy. Now, next couple slides, we want to talk about one of the big risks. We've been talking about this all year long. It's inflation. What I have on the screen is the consumer price index less food and energy, and I'm going to stress that in just a second. But I'm illustrating this as a 1 year rate of change. So what's the measurement today as it relates to 1 year ago? Okay. So first of all, why are we looking at the consumer price index less food and energy? What does that mean? Well, when we look at this measurement, we're removing food prices from the measurement and we're removing energy prices from the measurement. And quite frankly, the only reason I'm looking at this is because if you read an article or you watch a newscast and they talk about inflation, this is most likely the CPI measurement that they're looking at. I don't remember when this started, but many years ago, somebody made the case that when you look at consumer prices and how they change, you should remove food prices and you should remove energy prices because those two sectors of the basket of goods, they tend to be the most volatile. Well, I don't know about you, but I eat every day. I consume energy every day. So why would we look at the consumer price index basket of goods without those two measurements? Again, we won't go into that debate any further for today. We'll just know that I'm showing it because that's most likely what you're used to looking at or used to hearing about. And so whenever we talk about inflation, the question that frequently comes at us is, do we think we're going to see hyperinflation? I would contend that I do not anticipate seeing hyperinflation, but I would also contend it doesn't matter. Naturally, if we see hyperinflation, of course, it's going to be more dramatic and more painful than higher inflation. But my point of saying that is, first of all, we've never witnessed hyperinflation in our country since the founding of this country. So immediately prior, so right before 1776, there was hyperinflation, but there's a reason for that, and I'm happy to explain it if you want to know history. But since then, we've not witnessed hyperinflation. We have, however, witnessed higher than average inflation or prolonged and elevated inflation, and that's what we're concerned about. So on the right-hand side of the screen, you can see that we're pushing 10 or 11% in terms of how this measurement compares to where we were at just a year ago. That's high. And if we experience that for a long period of time, that is absolutely going to hurt our pocketbooks. It's going to arguably hurt the economy, and you could argue that, as you see on the screen, whenever this measurement increases, these beige bars are the recessionary time periods. And so whenever the inflation gets going, we tend to see a bit of an economic recession. So the next way that we want to look at this is the same measurement. So on the bottom panel, the green panel or the green line is that same measurement. It's a consumer price index minus food and energy using a 1-year rate of change. On the top panel is the federal funds effective rate. So I've got here August 6, 1979 illustrated. This is the date that Paul Volcker was appointed as the chairman of the Federal Reserve. President Carter appointed him, then President Reagan reappointed him, and he is largely credited for breaking the cycle of inflation that the nation was experiencing at the time. But I want to highlight, where was it when he was appointed? It was only approximately 6.6%. You see that on the right-hand side. I've got the black line drawing to the right, saying that at the time it was about 6.6%. And what did he do? He started raising the federal fund. That's not the only thing that he did, but it's the easiest thing that we can show on a chart like this. They started raising the federal funds rate. Well, right now, again, the blue box on the far right side, we're at effectively 0.8 is the effective federal funds rate. So we have to try to keep the scale in mind. But Chairman Volcker eventually got the effective federal funds rate up to 19%. Right? Again, I'm not trying to be prophetic. I'm not saying that that's where we're headed. But look at where we are at now. The inflation that we're already been experiencing is higher than what was problematic that prompted the dramatic rise in the federal funds rate. So that is something that's concerning to us. Now, when we talk about inflation, one of the things that we frequently hear, and there's truth to this, is, hey, well, should we put gold in the portfolio because gold is a store of value? There's a limited supply of gold, so therefore there's a better store of value. And historically, in periods of high inflation, gold does very well, or fairly well, I should say. On the chart right now is the spot prices for gold. It's a 1-month bar chart or candle chart. And the reason I'm showing this is because the questions that we're getting more and more frequently now is, well, is Bitcoin and cryptocurrency, are those the new way that we should be combating hyperinflation or high inflation? Again, not hyperinflation, but higher inflation. Should we be looking at cryptocurrencies as a way to combat higher inflation? Well, let's talk briefly about it. So on the screen now is the new ETF BITO. This is the ProShares Trust Bitcoin Strategy ETF. First of all, as a reminder, I'm not recommending this as an addition to your portfolio. If you want to talk about it, obviously feel free to reach out to me or my team and we'll chat. But I'm highlighting this because this is an ETF that was launched this past month. So it was pretty groundbreaking in that, for that reason. But what I want to show you, I should have put a price measurement on this. You can see a very negative gap down on what is this, 1, 2, 3, 4, 5, 6. On the 7th day of trading, it was very volatile on the downside. But because that history is so brief, let's look at something that's been out on the market a little bit longer. This is Ethereum. This is the Grayscale's Ethereum Trust. Again, not a recommendation. I'm just trying to show as an example of what's happened in this particular cryptocurrency. And so in this particular cryptocurrency, what's on the screen is this calendar year, 2021. And from the top in May to the bottom in July, From that correction, that is about a 62% correction. And again, that's just 3 months. That's a pretty volatile swing. Now, so can something like this help combat inflation? Well, obviously, if it's going to move up and it moves in that magnitude, that's obviously going to help us. The challenge is the rate of change. Again, 60% decline in just 3 months. This is the monthly chart, the same position, but a monthly chart. You can see this red bar, a red candle, in the next 2 months, just top to bottom, that's about a 63% decline. Most clients would not really be able to tolerate that. So historically, gold as a store of value, you really can't say that just yet with the cryptocurrencies. It's something that we have to take a look at and potentially put in a portfolio. It's not necessarily going anywhere anytime soon, but if we're going to do that, we have to do that very, very carefully, and there has to be strategies around both entries and exits because it can be so volatile, and it has been so volatile. So again, feel free to reach out to us if you have any specific questions in relation to that. 2 more slides and we'll wrap up. The reason I've been highlighting this for so long is just it's a reminder that the stock market, United States stock market, does not consistently move up. There are periods of decline. We've witnessed that. Just last year we had a very bad correction. It was very pronounced and very, very compact. Well, ever since then, hey, the market's moving north. Well, the market doesn't always move north. This is a period of 15 years where the stock market in the United States moved sideways, but it moved sideways in a very violent fashion. So it's not all roses. We need to be careful when we're talking about investing. And so the way that we would encourage you to think about this is take your age and add 15 years. What if the stock market did this for the next 15 years? How would that impact you? And what should we be doing about that? Well, this is part of the reason why we believe in active portfolio management, because it's not all roses. The stock market does not always move up. And there are definitely periods, even in our nation's history, where the market can be very volatile over a long period of time. So again, not trying to be prophetic, but it is just a reminder. There are reasons why we do things the way that we do. But I don't want to end on a negative note. Let's end on a positive note. September was a pretty negative month, and one of the things we talked about in last month's video was how bad it was. So September was really bad in relation to a bad month. So September historically, as you can see on the chart, since 1950 is the worst month for the S&P 500, and last month was far worse than the average bad month. Well, thankfully, October was far better than the average October. So we're certainly pleased to see that. The other reason we would like to end on this note is because we're entering a period, November through April in particular, that is historically a very good time for the stock market. So you can't just say, hey, November is always good. That's not always true, but it is a reason for us to be a little encouraged when we look at underneath the surface. There are obviously concerns, but overall on the level, we like what we're seeing right now. So again, my name is Ted Hicks, and I'm the Chief Investment Officer for Hicks Associates Wealth Management. If we can be of any service to you, feel free to reach out to us, either me or my team. You can reach me at the email address above. The phone number and the website is there as well. I hope you found this video helpful, and we will see you again next month.